Okay. Welcome, everybody. It's good to be with you all today. Thanks for joining. And I'll just say right here as we start that this is not a fake background. I'm actually in the middle of nowhere in South Louisiana at the moment, down in the kind of the River Delta area, and scrambled to find a place where I could get some decent signal here to jump on the call here with you today. So thank you all for joining wherever you are, and it's good to be with you. And I know things are incredibly busy, incredibly challenging at the moment. It seems like every time we get on one of these quarterly webinars, there's always something going on out there. And sure enough, here in the last week, we have some good old-fashioned runs on banks, creating a significant amount of disruption in the banking system, which obviously affects each and every one of you on the call here today. So we appreciate you carving some time out of your day to spend with us, and hope that we'll have some things that are insightful to share with you. We always try, as we prepare for these, especially in times like this, to at least leave you with some positives, because a lot of the numbers that you'll see today are not all that rosy. But then again, that's not news to any of you that are on this call. But we don't want to pile on with a bunch of additional negativity, and try to share some positive things with you and some takeaways that hopefully you can apply in your businesses. And so we'll try to do that here today. So just a couple housekeeping items here as we get started. As always, this will be recorded, and the recording will be sent out here within the next few days to all those that have registered for the webinar today. And then if you have questions throughout, you'll be on mute. If you have questions throughout, feel free to drop them in the GoToWebinar chat function. We'll get those questions during the webinar. We can address some of them as we go. And hopefully we'll also have a few minutes at the end where we can respond to some questions that come up during the webinar. And this will be a CPE webinar. So those that are looking for CPE, you will be able to receive a CPE credit for attending this webinar. But just keep in mind, there will be some questions, some poll questions that pop up. There are 3 of them during the webinar. You will have to answer those in order to get credit. That is a requirement for anyone that hosts CPE eligible training. So make sure you fill those out, and then the CPE certificates will be emailed out to those that complete the survey here within the next couple or few days also. So I'm excited to be joined by a few members of our team. Some of them you've been familiar with here over the last several of these Trend Series webinars. Molly Manuzak, who leads our business intelligence, data analytics, and benchmarking team here at the firm. She'll be presenting some quarterly data and the full year 2022 data that is just recently into us, that we've recently compiled as part of our Richey May Select quarterly data benchmarking. And then we'll also be able to hear some thoughts from Seth Sprague, who is a director in our mortgage bank consulting practice, and he'll share some insights from the data and from just some other kind of market trends and information. And then we'll also hear some thoughts from Michael Nugier, who is the leader of our cybersecurity practice here at the firm, and he'll share some important reminders and takeaways for everybody to make sure that they don't neglect at a time when things are already challenging enough. And companies are making cuts all over the place, as they certainly need to. But some of those cuts can leave a company exposed, and there are risks that that are avoidable, and you don't want to layer those on top of the risks of the business that are unavoidable. And so we'll share some of those with you here today. There are plenty of risks, as we know, and plenty that companies are trying to do in today's market to deal with the challenges that we're all facing with significantly reduced volumes and much thinner margins than everybody would like to see. And really, we're seeing all things, companies trying just about everything to get to a point where they can break even. Certainly servicing has played a role in that for many companies over the last year, as the margins on the origination side of the business have been very challenging. There have been a lot of cuts to back office personnel, headcount. There have been a lot of cuts in the technology areas. Companies have come to realize that not all of the technology that they've plucked off of the shelf over the last several years is really needed. Some of it is duplicative. Some of it does not generate the kind of ROI that they were hoping up front, and upon further analysis have come to the realization that some of those technology expenses can be eliminated. We're seeing some technology that is effective as we work with clients. We're leveraging some of it ourselves. So a shameless plug, perhaps, if there are some things, or if you'd like to have a conversation around technology, feel free to reach out. We could share some thoughts and insights with you. Shoot me an email or give me a call, and be happy to visit with you about those. We certainly are seeing some things that are working and working with some clients in some areas. But as a lot of companies have figured out, they just have to look across the entire organization and make cuts wherever they can to personnel, lease expenses, and technology is of course one of those. So we'll share some of those thoughts with you here throughout the webinar today, and as always, we would love to take any phone calls from any of you, or send an email. Love to schedule time to visit with any of you in more detail, one-on-one. But just by way of background for those that might be joining for the first time today and maybe aren't familiar with Richey May, we do a lot of work in this industry and have for many years. Work with 300 plus mortgage companies around the country, and we work with them very, what would I say, intimately. We know them well. We work with them around financial statement audit work, tax work, and in a number of consulting areas as well, and compliance and technology. So we know these companies well, and have a lot of data available to us, and have watched that data closely for a number of years now, and have a lot of historical data, can see trending, and so we have a lens across a lot of companies, and spend a lot of time working with our clients, and hear a lot about what's going on and what they're doing, and so we're grateful for the opportunity we have here to share some of those insights, some of those thoughts with you. So without further ado, I will hand things over to Molly, who will share some insights gleaned from the quarterly and annual 2022 data. So Molly, take it away.
Great. Thank you so much, Nathan. Thanks everybody for joining today, for taking time out of your busy day. So for those of you who may not be familiar, my team is responsible for several analytic and benchmarking offerings here at Richey May, including Richey May Select, which is what I'm going to be going over today. So Select is a quarterly financial benchmarking program that we've been running for over 10 years now. We have about 75 IMBs participating. They submit their quarterly financials, and then they're able to see that in comparison to their peers. So peer groups in Select are broken out by size and channel mix. And as Nathan mentioned, today I'm going to be going over results from Q4 and then 2022 as a whole. And we'll be looking at both origination trends and some key financial metrics. So in Q4, we continued to see a decrease in production overall. We also saw a decline in net production income, and then we also saw cost to originate per loan go up again this past quarter. And then when we look at the whole year compared to the prior year, we saw all of those same trends as well. So we'll be looking at the entire select population for Q4 in prior quarters, and just keep in mind that we have companies of all channels, sizes, product mix, etc. So really we're going to focus on trends or changes in averages over time. So I'll start first with some origination trends. So here we're looking at average production over time, going back to 2017. Definitely not a surprise here, but volume was down quarter over quarter, which is definitely expected given the rate increase that we've continued to see throughout 2022. So Q4 is typically a bit slower from a seasonality perspective, but compared to Q3, we were down over 40% on average from the prior quarter. And that decrease was seen essentially across the board, particularly in both purchase and refi volumes. As a percentage of volume, we did also see another increase in purchase production, which is up to 90%. That leaves refi production to be about only 10% of total production, which is a program low for us here. When we look at 2022 as a whole, production is also down significantly. It's down about 50% compared to 2021. So now I'll go into some of the financial trends that we saw in Q4 and last year. So what we're looking at here is net income compared to net production income. So net income is going to be that GAAP net income that you'll see on your audited income statement. And NPI, or net production income, is intended to show origination platform profitability. And if you're not familiar with this metric, essentially what we're doing is we're excluding a number of items from that GAAP net income to get to a more apples to apples comparison so that you can compare to the different peer groups. So we're removing items not related to originations or production, so anything related to servicing, and then outside investments and activity. And then we're also minimizing noise by removing unrealized gains and losses. So this includes removing unrealized gains and losses from the unfunded lock pipeline, which is removed from secondary gain on sale, and then removing any loan loss reserves. So last quarter, as you can see on the screen here, both metrics were negative. And in Q4, we saw the same thing, and the gap between the two did widen to about 52 basis points. So net production income, which are these green bars on your screen, was down in Q4 on average about 29 basis points from Q3, taking net production income down to negative 91.3 basis points. So this was, of course, driven by decreases in production and revenue and increases in costs in terms of basis points. And I'll get into costs in a little bit. And then when we look at 2022 as a whole, net production income was negative on average for the year. And that was actually the first time that we've seen that negative NPI annually in program history. So next we'll look at that GAAP net income, which you can see is also down from Q3. That's this blue line on your screen. That was the second quarter of negative net income in 2022. And Q4, the drop was also driven by the same thing that we saw in net production income. So due to decreases in revenue and increases in expenses in terms of basis points. And then when we look at the entire year, net income was, of course, down compared to 2021 and negative as well. So next, we'll dive a little bit into secondary gain on sale from our net production income report. And so that report and this gain on sale number is intended to show realized gains and losses. And again, this is an average of all select participants, so just something to keep in mind. We did see an increase actually in Q4. That number was up 15% or 37 basis points on average for Q4 compared to Q3. But again, that's due to the fact that we're removing those unrealized gains or losses. And in this case, we were removing, that unclosed interest rate lock commitment and open hedges. So here we're looking at the entire history of the program all the way back to 2012. And so the number that we saw in Q4 was back closer to averages we saw earlier this year. But again, that number is still relatively low. And you can see the last time we were at these levels was all the way back in 2013. And then when we look at secondary gain on sale over the entire year, it was down about 78 basis points compared to 2021. So lastly, we're going to take a look at cost to originate on a per loan basis, looking at dollars per loan. So here we're looking at all expenses just related to origination. So again, we're removing anything related to servicing and then those outside activity or investments. And then we're dividing total costs by closed loans over the period. So we did see another increase this quarter looking at Q4. Q4 on average was up about 15.5%, up to just under $14,000 per loan. This is another high in program history when we look at costs on a per loan basis. I will point out that expenses were down significantly this quarter, which was, of course, like Nathan mentioned, driven by a reduction in just overall cost saving measures, including headcount. Total headcount or personnel was down about 27% on average compared to Q3. So staffing definitely continues to be a challenge in this market. However, costs are still up on a per loan basis due to that decrease in production. So when we look at both, personnel and operational costs, they were down on a per loan basis. We'll take a look at personnel first. So personnel, although up on a per loan basis, was actually nearly flat for sales departments, so producers and non-producers. Again, likely due to continued staffing changes over the period. So again, a large drop in overall expenses, but that cost per loan is nearly flat. Otherwise, in other personnel departments, we did see increases on a per loan basis. So fulfillment departments were up about 10% and back office up 23% on average compared to Q3. And then looking at ops and overhead expenses, that was up the largest amount, about 39% compared to Q3. And then similarly, when we look at 2022 as a whole, cost to originate was up 27.1% on average. It was only up over the year $2,400, compared to the large increase we saw in Q4. So like I said, total expenses were down, but since we're allocating them to a significantly smaller number of loans, we saw an increase on a per loan basis. So I'd just like to end with a couple of thoughts here. Like Nathan mentioned, the numbers that we're looking at are not shocking given the current market, but that doesn't mean, that they're tough to see or tough to review. We continue to see volatility in rates. We did see rates go down a little bit at the end of last year and early this year, which was of course welcome. It, brought production up slightly. But then in the last month or so, we've seen rates start to tick back up. So given this, ongoing unpredictability, it's really important, especially now, to continue, to be vigilant and ensure you're assessing and aligning expenses with revenue. Fortunately, over the last couple of days, we've seen rates move back down, but we do expect continued uncertainty. So before we move on, we're going to go ahead and stop for a quick poll question. And again, if you're looking to get that CPE credit, you will need to answer all 3 poll questions. So the poll question is, how are your volumes in Q1 2023 compared to Q1 of 2022? So either production volumes went down 0 to 15%, down more than that, flat, up 0 to 15%, or up more than that. So we'll go ahead and give everybody some time to answer. Okay, we're going to give you guys a few more seconds and then we're going to close the poll. Okay, so here's the results of the poll. It looks like the vast majority are seeing volumes down more than 15% compared to Q1 of last year. And it's hard to believe we only have a couple weeks left of Q1 of this year. And before you know it, I'll be jumping on again to share Q1 results. So thanks everyone for your time. I'll go ahead and pass things over to Seth for some insights on profitability and servicing trends.
Great, thanks, Molly. And as no surprise to folks, it looks like Q1's certainly going to be a challenge on the origination side of the house. For those that have grown their portfolios or grown their originations, I would say it's more likely a function of probably acquiring talent. So it is a constant battle out there to try to grow through some of these cycles. There's been a lot of M&A activity. Ken Richey here leads our group here at Richey May on the M&A side. He's certainly busy with a lot of opportunities as well. So on a positive note, let's talk about that 2022 was the year of MSRs. So Molly, if you go to the next slide. We are in award season here in Hollywood, so I just wanted to make sure that servicing got its appropriate shout out in 2022, that it certainly was the MVP for the mortgage industry in 2022. We had historically low prepayment speeds. In fact, CPRs ended the year in the low single digits, which in many ways was below what a lot of people would believe was actually the structural floor to prepayment speeds. We were seeing CPRs print in the 2 and 3 range on certain coupons. So tremendously strong cash flows. Widespread between the par mortgage rate and the outstanding mortgage rate. Low defaults and foreclosures. Part of that was a moratorium, part of that was ending moratorium. Delinquencies on servicing did remain in check, though they did start to tick up a little bit in the fourth quarter for the MBA data. Third quarter as well. Generally, property values were rising. You could read all the recent trends, though. If you're West, Colorado and West is certainly having a different viewpoint on housing values at this point. Escrows, those pesky T&I balances were worth a lot more in 2022 as the Fed raised rates on the short end. Servicing costs generically remained in check for the latest MBA data. They didn't really go up much. And there was a lot of transfers. So if you had servicing in 2022, you experienced probably the best servicing cash flows that you will ever experience. You may not have, if you tried to trade your servicing, you may not have achieved all those cash flows or that value in a transaction. But if you did hold servicing, and through 2022 is probably the best year of servicing cash flows ever, I would expect, it's always hard to give forward guidance, that 2023 is likely to be a good year for servicing, probably a very good year for servicing. May not be as strong as 2022, but still a good year for cash flows. And for those entities that have retained servicing and retained critical mass of servicing, as I like to refer to it, they are offsetting a fair amount of their expenses with the servicing cash flows. So it's nice to get that monthly cash in from your servicing portfolio. So if you go to the next slide, Molly. As we look at the value, there was a slight downturn in values in the fourth quarter of 2022. So servicing clearly won the first 3 quarters. There was a modest write-down. This is data collected from public disclosures of banks. There's 8 large banks in here. This is their portfolio trend of values back to 2010. And you can see that we achieved the highest values as a percent of UPB in the 3rd quarter and really the 4th quarter of 2022 that we have experienced over the last 12 years. That's so good with numbers. About 12 years of data. And obviously the reasons on the prior page were the reasons why servicing had such a write-up in values. We get the question quite frankly, quite a lot, can servicing values continue to go up? And the answer is prepayment speeds are sort of at their lowest levels. We think servicing costs probably increase at some point. Delinquencies may be increasing. So values here may have capped out. Cash flows will remain strong in 2023, but it's just a record year for servicing, and we want to make sure that they get their MVP award for 2022. On the next slide, this is the value change percent. And you can see a modest decline in the 4th quarter. Most of the significant write-up in the MSR value did occur in Q1 and Q2 of 2022. If we go back just a little bit further, the largest percentage increase in recent history is actually Q1 of 2021, which was followed by the largest percent loss recently of Q1 2020. Don't exactly remember what 2020 was known for. Oh yeah, that was when the Fed dropped rates and we all had to shelter in place. So MSR values are probably reaching what I'm going to say terminal values, but that doesn't necessarily mean those cash flows don't remain strong for folks. Next slide, Molly. As we think about MSR portfolios, this is a similar slide that I presented to the Texas Mortgage Bankers Conclave, because the question was who is exiting servicing and who's growing their servicing portfolios. Again, this is public data from all these companies, and this is their MSR portfolio. So if you look at a Wells Fargo as of the end of the year, they had 680 billion of serviced for others. That would be Fannie, Freddie, and private servicing. If you look at a percentage change from 2020, they're down 20%, and from 2019 levels, they're down 36%. Everyone else on this list, with the exception of Western Alliance, and we don't quite have full data on Western Alliance, who's owned by AmeriHome. They purchased AmeriHome. We just don't have the Q4 2022 numbers for them because they went public and that number just never got disclosed. But generically speaking, you see both banks and non-banks growing their servicing portfolios in double-digit percentages for the most part. So servicing, while we talk about it is being more dominated by your non-depositories, you know, your new residential / Rhythm, your Quickens, your Mr. Cooper / Nation Star, your PennyMacs, your United Wholesales. The banks are also, to a degree, increasing their servicing portfolios as well. Some of this is just function of loan size and higher balances, but also some of these folks actively buy servicing, like a PNC Bank, which in 2022 bought $70 billion of servicing. And Mr. Cooper bought a lot of servicing last year as well, per their public disclosure. So anyway, just a viewpoint on MSR portfolio balances, who's growing, who's not growing. We're going to pivot to the next slide here and talk about, we have a poll question. So again, for CPE credits, you want to make sure you're answering this question to get your credit. So what are your MSR plans for 2023? Grow, shrink, sell, or maintain? And by maintain, I just mean sort of organic growth. You're not necessarily going to sell it. You're not necessarily going to shrink it. Whatever happens off the originations and runoff is what you're going to see. So again, for your CPE credits, you want to make sure you answer these questions. Otherwise, we cannot give you your CPE credit. And we'll give folks a few more seconds here to reply so that they can get their credit for CPE. And as that comes in, we did get a question, MSR values as a percent of UPB. That is the MSR reported value. It's not necessarily their basis, but I would tell you that all 8 of those banks that are on there are under fair value accounting. So their basis and their fair value would be the same. We didn't have anybody in there who was under LOCOM to try to answer the question that came in on the fly. Okay, so the results are some people plan to grow, some people just and most people just maintain it organic, and 4% shrink. You know, the MSR market continues to be active. There are concerns about the volume of trades that may come out from certain large banks that have announced that they may be exiting a channel or two. So we'll see how it goes for the year, but servicing cash flows are likely to remain strong in 2023. Molly, if we pivot to my final section before we get to Michael, because I want to give him plenty of time to talk about cyber, return to profitability. On the next slide, we're going to talk about, oh, went the wrong way. We're going to talk about the various ways that people have looked at profitability, but on the origination side of the house, we're seeing similar data off these 8 banks, 9 banks that are on this sheet, that origination volumes year over year are down 70% and 41% in the quarter. If we go to the next slide, Molly, we've got gain on sale very quickly, and this is reported gain on sale. Similar to the stats that Molly produced, it was up in the quarter, so Q4 was better than Q3, but year over year down 30%. Again, this is their calculated gain on sale. It's not necessarily sort of total production profit. If you look at releases, you can see some companies actually lost money on the origination side. As we go to the next slide, we're looking at the mortgage rates. And again, as Molly highlighted, mortgage rates were trending back towards 77% mortgage. I almost said 70% mortgage. That would be a very tough market, I think. 7% mortgages. And then with Silicon Valley Bank and Signature Bank being taken over, their failures, you know, mortgage rates are down. The expectation is that mortgage rates remain very choppy here. Fed expectations next week, Goldman Sachs says that they're not going to raise rates. Other people say they are going to raise rates. So we'll see what happens next week with mortgage rates, but mortgage rates did, at least in January, start to migrate back towards 6%, and then they migrated back towards 7%, and this week they're probably down. Next slide is the trend. This is from the Fannie Mae Home Purchase Settlement Index. This is one of my favorite slides to talk through. As we think about the purchase season and the spring and summer purchase season, 78% of people on this survey thought it was a bad time to buy. That number is equivalent to the numbers that we saw when COVID struck back in 2020. So from a buyer side demand or buy side demand, I just say maybe tepid. It's up to loan officers and originators to make sure people understand the cycle of mortgage rates. And the next slide, which is going to be way too busy for me to talk about, is treasury rates. I found this on LinkedIn. The source of this is Creative Planning. And I just thought this was a great visualization of mortgage rates. And in particular, if you take that 30-year fixed, the 10-year column on treasury rates, if you typically add 175 to 200 basis points to that rate, you typically get where the mortgage rates should be. Mortgage rates are exceptionally wide to treasury rates right now, which is having implications on buyers' willingness to buy those and the TBA market. And this is just showing you that we are definitely in a inverted yield curve and historically inverted yield curve between the 2-year rate, at least when this was published as of March, before Silicon Valley Bank and Signature Bank went out, because the 2-year rate has moved materially this week if you're watching it. But again, that the longer end is sort of the expectation of where rates are going. The short end is driven by the Fed. Just a great visualization of where rates are over time. So I included that. And so as we go to the next slide, we want to talk about what we have done as an industry. And look, we, in my opinion and humble opinion, we have done about as much expense management and right sizing of staffing levels as we can do in the industry. That's why this one's got 2 strike-throughs through it. If you haven't, you're probably not listening to this call because you're no longer in the mortgage business. We have cut staff. We may have cut too much staff. The other thing that I think that we have done a good job on is refocus or focus in on core competencies with production operations, right? 6 months ago, everyone was going to do HELOCs. 6 months ago, everyone was going to do construction perm. 6 months ago, everyone was going to do FHA assumable loans. I think we've kind of narrowed the product list down a little bit and are focusing on where we really can be profitable, which is good. What is still to be done? Look, the acquisition of more talent. You could look at Guild Mortgage, which has bought 3 mortgage companies over the last 3 or 4 months, right? There is times like this where you invest in getting more originations in. Even on our origination quick survey, there are some people that are growing. So again, good time to invest in talent. We're hoping that that traditional spring and summer purchase market occurs, that buyers accept those rates, though we see some headwinds there with that Fannie Mae survey. We hope there's adequate inventory, though that continues to be a struggle. We'd like to see the employment market stay strong but not overheated. We would like to see that 10-year treasury to mortgage rates normalize. We would like to see inflation perceived to be or actually under control. We just got a print of 6% the other day. And probably the most important takeaway from my section, not the pretty treasury graph, is avoid making some short-term decisions that appear to boost short-term results that can result in long-term losses. Whether that's you've cut staff to the level that you can no longer fight repurchase requests, or you've cut your technology to the point where you're opening yourself up to incremental cyber threats, or you've cut your underwriting staff so that they're just not of the same quality that they used to be, and now you're going to produce even more loans in the future that may have defects. So as you think about going forward and return to profitability, we do still need some things to occur, like a good, solid, traditional spring and purchase season of mortgages. We need adequate inventory. But most importantly, we need to make sure that we're not incrementally increasing risks that give us a short-term boost on the income statement that sort of produce long-term potential liabilities for our company. With that, I'm going to turn it over to Michael, who's going to talk through a lot of what we're seeing on the technology side and the cyber side. In particular, he's going to emphasize a lot of these points around cost savings and potential outsourcing solutions that may be available to protect both your data and your company's reputation. So Michael, I'll turn it over to you.
Thank you, Seth. That was a great segue into what I wanted to talk about. If we can jump to the next slide here. Q1, right, what we're seeing, before I touch on the risk aspect of where we're cutting software, is really talking about what Q1 is bringing from an exposure and vulnerability perspective, right? It's really the cyber attackers' playground in the financial services industry at this point, because of all the vulnerability and uncertainty that's been created over the past even week and a half, right? We've already been in kind of a volatile market, and so understanding that, right, with banks like Silicon Valley and other regional banks having the newsworthy issues that they've had over the last week, we're creating opportunities for threat actors to socially engineer our teams, the human element, really understand that we are in a vulnerable and risky time inside of this industry. And so that's what this industry restructuring creates, is this opportunity for the threat actors. We've already documented well over 20 instances of phishing emails related specifically to SVB, talking about setting up for money quick loans, things that can help overcome that happened within the last week. And then couple that with, as Seth was saying, the cost savings initiatives that we're trying to perform in our organizations, this expense management, cutting things that might seem duplicative without performing the actual risk assessment around what which one to cut or which technologies to keep. And so right, that's causing some undue risk, or some what we call like the reality gap with risk inside of organizations, and opening organizations to these vulnerabilities and exposures. If we go to the next slide, I put together a graph around what this looks like, and it's really an eye chart for sure. And so I'm going to do my best to explain it without being able to point out things on this slide, but it really talks about what our risk appetite is, and that's really driving down along with our budget. And so our budgets are moving further to the left, and our risk appetites are moving further down towards the center of the axis here, which is essentially where our risk appetite and budget align to protect us from a risk perspective. And I'll be the first to tell you that throwing money at cybersecurity is not always the best solution. Understanding where to throw money is the best solution, and where to throw resourcing and where to accept risk is the best solution in making those informed decisions. But as we're implementing the expense management within cybersecurity, we're growing this reality gap, and so we're seeing this red arrow here move further to the left as we're minimizing our budget on spend. We're accepting more risk, and that's okay. Accepting risk is all a part of a risk management program, but understanding and doing the thoughtful analysis of what risk to accept, where you can transfer risk and still save costs, is important. And so making sure that we're doing that due diligence inside of our organization to understand what that reality gap is and what measures we're going to do to accept, transfer, or mitigate the risk that we're creating there. Right, and that risk comes from not just technology changes in our organization, but also resource losses. I will say it's really hard to quantify the ROI in cybersecurity, and so this new concept is cropping up of the return on security investment within inside of the cybersecurity industry, and how you can quantify risk outside of a financial perspective when we're looking at the amount of breaches that are happening, the industry vertical that we're in, the cost of the breach and how that's increasing over time. And so making sure that we're considering that with our risk, and we're thoughtfully outlining the impact of each risk that we see and the likelihood of it, and making sure that we are putting in the proper measures to cover those risks. And so this graph, again, kind of an eye chart. Happy to walk through this more at another time if anybody's interested. It's quite compelling when we talk about what we're willing to do inside of our organization and what is required of us. Right, we're in some might argue an overly regulated industry inside of the financial vertical, and so accepting risk that is a regulatory requirement is also not a cost savings initiative at some point. That is it is going to be a negative expense in the future. And so again, aligning that risk program with the regulatory requirements that we have from all different, whether it's state requirements, right? If you're operating inside of New York, their requirements are the most stringent of all states, and they have proposed changes coming down with the NYCRR 500 changes that are looking to be implemented around the July timeframe. The cost of those has been, I guess, dramatically expressed in all call for comments towards the proposed rule changes. And so again, just making sure that we're bringing in the full picture of risk and regulatory requirements and what we're willing to expose our organizations to, and the data that we're protecting inside of these organizations moving forward. Let's go ahead and jump to the next slide because it's a compelling graph as well. As we see the exposures over time, this is a graph that probably won't make a ton of sense to most people on this call, because it is really hyper focused in the cybersecurity industry. In the year 1999, the IT industry started documenting common vulnerabilities and exposures, and these are software weaknesses that can lead to a breach within inside of your environment. And so as we started monitoring that over time, you can see some dramatic increases in 2004, 2014 with the bump, and then a loss in 2015, and then in 2016 a dramatic increase, and just exponentially so year over year, continually moving up. And so these are weaknesses that common softwares pose. And so what you would have seen from a newsworthy perspective in the last couple of years would be something like a Log4j that came out that put a lot of organizations through the ringer in understanding what exposure, if any, or what risk they had with a vulnerability like that. And so as you see this graph rising, it's creating a I won't say a management nightmare, but a management problem around the softwares that we are implementing inside of our environment and what we're doing about that. And so we do continue this to rise, especially with the increase in software development due to the recent boom in artificial intelligence with tools like ChatGPT. Just yesterday or the day before, they released their new version of their artificial intelligence platform, version 4, which was a well over 100% increase from 175 billion data points to 100 trillion data points that it is able to leverage when performing any task inside of that. And so the artificial intelligence capabilities and how that's going to increase productivity and efficiency within inside of organizations is also going to increase the security risks, as there are just starting to become standards around the use of artificial intelligence. And so it is kind of the Wild West right now. The National Institute of Standards and Technology just released their risk management framework for artificial intelligence in January, and it is still in its infancy. And so I would expect this graph to continually rise year over year as we are transitioning more and more into cloud-based web application utilization for all of our tool sets, and then couple that with artificial intelligence. Let's jump to the next slide as we talk about, we already mentioned the increase in exposure and risk and vulnerability due to the current landscape, but this is just some general awareness and some tips to employ, not just with Silicon Valley Bank, but in general when receiving emails. We are in a highly targeted industry, and we also all have some form of social media for the most part that people are using to garner information about us so that they can send us emails to try and trick us into clicking links so that they can steal our password or change account numbers or do whatever. And so during this time of uncertainty, and as we are employing our cost savings tactics inside of our organizations, it's best to continuously educate the user base within our organization, as we're all responsible for protecting that data that traverses our environment. And so making sure that we're hyper vigilant, being cautious of unsolicited emails and phone calls. If you're not expecting the email, it's best to not respond or ask somebody if it's legitimate. Do some research about the user. Don't click on the link, hover over it, make sure it's a legitimate website and not a copycat website. Oftentimes you'll see like Microsoft, but the O in soft will be removed, and most people's eyes don't catch that type of change inside of their phishing emails. Again, verify the sender email address, make sure it's not a copycat email address. If you weren't expecting it, please reach out to the user and ask, hey, is this legitimate? It does not take a lot of time, and it can prevent hundreds and thousands of dollars worth of damage inside of an organization. Again, don't click on the link, and always utilize your trusted resources, your IT department, any third-party services you're using to help manage IT or cybersecurity, and ask if it is legitimate. but do not forward emails to internal resources that are not the trusted resources from a cyber IT perspective, and ask them if it's legitimate, because that we have seen specific use cases where somebody will forward an email and say, hey, do you think this is legit? And that person will click it and they'll be impacted from that perspective. So make sure we're leveraging the right resources when we're looking for support around that. I'll jump through a couple more slides here. We did talk a little bit about artificial intelligence. The benefits are undeniable on the efficacy increases and the productivity increases that it can provide within an organization. I'm not going to touch too much on that, but ChatGPT, a Microsoft-backed nonprofit at this point, is really leading the industry in innovation in the artificial intelligence, large language model, artificial intelligence chatbots. And so you can chat this artificial intelligence anything you want, and it will respond with a thoughtful answer. It will produce reporting or data for you on a whim. But there are risks with that, and I do want to call those out as well, as we're starting to enter into this arena more and more, and people are using it because it is free. And so as you are using it, make sure that the data that you are putting into ChatGPT or other large language models is not intellectual property or private information of the customers and data that we have. Make sure that you are asking it benign questions. Don't put customer information in there, because these artificial intelligence models train by the data that we put inside of it. So if you are putting data in there, there is a chance that it could be recovered from another third party. And then we've also seen the use of artificial intelligence to create persistent and advanced threats from a cybersecurity perspective. Just like development teams can use this to create applications, they can also be used to create malware. There are some security stops on ChatGPT. However, it is not perfect. And it is also made for the ease of social engineering. So typically from other language or English as a second language attacks, ChatGPT can provide a social engineering attack in perfect English. Let's go through the next couple of stats while we have it specifically related to the mortgage industry. This is what Q4 looked like year over year. We did see a stagnant level of attacks across the financial and mortgage industry. It actually decreased a little bit in Q4, but year over year we saw some pretty dramatic increases of about 10 to 15% of attacks within the mortgage industry. If you jump to the next slide here, this is just the cyber attacks by month within the financial services industry, and so that just provides a greater level of detail of what's happening here. You'll see the green line is just leaps and bounds above the rest of the years, and while we did see a cool down towards the end of the year, it is still much higher than prior years. So important to note that cyber attacks are on the rise, and I think as we start to get Q1 data for cyber attacks in the financial industry, we're going to see that it is higher than the prior year as well, by about 10 to 15%. If we jump over to the next graph we have here, this is just a breakdown of the most common attack types within inside of the financial industry. Again, malware is the most common attack type. People are getting emailed this, they're downloading things off of websites that are non-legitimate. And then the second most would be business email compromise and account takeover. Those two are relatively combined because one leads to the other. And so what we know is that ransomware makes up the majority of malware, and it's impacting organizations within the financial services industry. And then the second most common attack is somebody stealing credentials and taking over your email and sending out emails as you, and using that implicit trust to garner more information, money, whatever it might be within the financial sector. We'll jump to some key takeaways here. Again, cyber attacks are on the rise. The risk of a data breach is increasing on a daily basis. And so as we're employing those cost savings techniques inside of our organization, we are considering risk before we just make a change to what is protecting our organization. Stay vigilant on social engineering attacks, again, considering the risk on any organizational changes. Utilize your trusted advisors, and as always, cybersecurity is a journey, it is not a destination. And so remember that as you are employing changes towards your IT and cyber programs. And then I'll pass it on from there. I think we have a polling question. And that is, has risk been a consideration in your IT and cybersecurity cost savings initiatives? This is a yes, no question. There's no failing this one.
It's my time to test.
As a reminder, this is the last poll question. If you wish to receive CPE, it's really important that you get this poll question in. So please make sure you answer if you're looking for that CPE.
And as we've got people filling that out, we will sort of publish the results, but we're pretty much out of time here. We'll follow up with any of the specific questions that came in through the chat. But I'd just like to thank everybody for their time today. Thank everybody who attended. We appreciate your time. You know, it's a busy time in the market. It's a busy time for March Madness. And so we appreciate your time today. Please fill out the survey at the end of this so we could continue to refine what we're presenting to you. As Nathan mentioned at the beginning, the slide deck and recording will be sent out over the next couple of days. And then for those that qualify for CPE credits, you'll get those over the next future days. And then if you are attending the MBA Tech Conference in the next month, I believe it's in San Jose, we will have presence there. Michael, Nathan, and Spencer will be there. So if you will be attending the MBA Tech Conference, please reach out. We'd love to sit with you about your IT needs, your tech needs, your cyber needs, in addition to some of the automated underwriting that Nathan mentioned up front. But thank everybody for your time today. Happy early St. Patrick's Day. Have a great weekend, and we look forward to chatting with you in the future. And as always, just reach out to any one of us on the call. We'll be happy to respond to any questions, but we appreciate your time. We appreciate you being our clients, and we will chat with you in a few weeks. Thanks, everybody.